In this section, we're going to cover the last three of the key components of the finance function. Number 3 of the key components of the finance function is Treasury Management. The term treasury draws its origins from the word treasure, making treasury management akin to the careful stewardship of an organization's treasure trove. In more precise terms, treasury management encompasses the strategic handling of a company's financial resources and holdings. The ultimate objective is twofold: to optimize the company's liquidity and overall value while proactively mitigating the various financial risks it may encounter. These risks range from currency fluctuations and potential overpayment of taxes to ensuring adequate funds for timely supplier payments. A critical aspect of treasury management is maintaining liquidity, ensuring accessible cash or the ability to quickly convert investments to meet impending financial obligations. The treasury function typically encompasses key responsibilities such as 1. Sourcing funds. 2. Managing currency exposures. 3. Effectively navigating tax implications. 4. And overseeing the management of working capital. Let's dive into the key responsibilities for treasury management. Number 1. Sourcing finance. Ultimately, the Treasury holds the responsibility of securing necessary capital for the business, an endeavor akin to a treasure hunt for financial resources. They must identify the required additional funding and determine the most optimal sources to obtain it. These sources of finance encompass various options. Banks, offering overdrafts or loans, debt finance. Shareholders, providing equity finance by purchasing company shares. Venture capitalists, extending debt and equity finance to support growing businesses. Individuals or businesses, offering loans. Debt factors, advancing funds based on expected future customer payments, for a fee. It's important to recognize that debt finance involves obligatory interest payments, while equity finance entails optional dividend payments to shareholders. This contrast results in debt finance being perceived as riskier due to its compulsory nature. Payments must be made even during challenging times. Failure to meet such payments could lead to the liquidation of the firm. Consequently, a higher financial gearing ratio, debt divided by equity, implies greater risk, potentially making it more difficult to secure additional debt finance. Despite its perceived risk, debt finance tends to be more cost-effective than equity finance. In summary, the Treasury's role in securing capital involves navigating various funding sources, considering risk and cost factors, and ultimately making informed decisions that align with the organization's financial goals and stability. Number 2. Currency management. Currency risk refers to the potential changes in exchange rates between different currencies. It affects investors and businesses operating internationally or dealing with foreign loans. Exchange rate fluctuations can lead to gains or losses, impacting assets, investments, and financial commitments. The Treasury Department plays a crucial role in managing currency risk. They employ strategies like hedging and financial instruments to mitigate potential negative effects of exchange rate movements. This ensures the organization's financial stability and safeguards against losses due to currency fluctuations. Number 3. Effective tax management. Effective tax management involves paying taxes in compliance with regulations and on time. Some businesses legally configure their finances to minimize tax payments, known as tax avoidance. Illegal manipulation of taxes is termed tax evasion and is unacceptable. While tax avoidance aligns with business goals, it can create a negative public perception. An example, Google has faced scrutiny for its tax practices. It was revealed that Google used complex financial structures to shift profits to countries with lower tax rates, reducing its overall tax liability. This practice is legal, but it raised questions about fairness and transparency. The public criticized Google for not paying its fair share of taxes in the countries where it operates, leading to debates on the ethics of such tax strategies and the need for more robust international tax regulations. Number 4. Efficient management of working capital. Capital management ensures the company has enough cash flow to meet its short-term obligations and continue its operations. This involves the following. Number 1. Cash management. Cash flow forecasting is a vital tool that predicts the upcoming cash balances in the following weeks and months. By identifying peaks and troughs in the cash balance, it aids in planning borrowing needs and timing, as well as the availability of funds to fulfill obligations to suppliers and creditors. It's crucial for the business to maintain a balance between having enough cash to cover daily expenses and avoiding an excessive accumulation of cash that could otherwise be invested to generate returns within the business. Number 2. Managing receivables. Receivables, also referred to as debtors, represent the funds owed to the business by its customers. Essentially, these are the funds that the business is yet to receive. In certain cases, businesses might require as long as 60-90 days to collect these outstanding debts. Such extended collection periods can substantially impact the company's cash flow. Number 3. Managing payables. Payables are the counterpart to receivables. In this scenario, we are the customers who have obtained goods on credit from our suppliers. In essence, payables represent the funds that the business is obligated to pay to others. The advantage of payables lies in their role as a form of interest-free financing. We receive the goods today and settle the payment at a later date. This streamlined approach allows us to consolidate our bill payments, rather than addressing each individual purchase separately. The principles guiding payables management are quite similar to those governing receivables management. After all, our receivables translate into someone else's payables, and vice versa. For instance, while we strive to collect outstanding debts promptly in receivables management, we aim to defer payment as much as possible in payables management. In both cases, we need to evaluate the trade-offs between early collection, payment, and associated costs or benefits. Number 4 of the key components of the finance function is company secretarial. Company secretarial responsibilities are typically managed by the company secretary in the United States. This pivotal role revolves around ensuring the company's compliance with statutory and regulatory requirements in the U.S. The company secretary might function within the finance department's purview, or this role could be part of a distinct legal department. The duties of a company secretary in the U.S. often encompass a combination of the following responsibilities. 1. Governance management. Overseeing the governance structures to align with the prevailing governance regulations in the U.S. 2. Legal compliance. Ensuring compliance with both U.S. business and company law. 3. Industry regulation adherence. Conforming to industry-specific regulations relevant to the U.S. business landscape. 4. Shareholder meetings. Attending shareholder meetings, partly to ensure compliance with meeting conduct regulations applicable in the U.S. 5. External communication. Maintaining connections with U.S. regulatory bodies and external organizations. 6. Reporting. Crafting shareholder reports and regulatory circulars in accordance with U.S. regulations. 7. Financial account support. Assisting in the production of financial accounts with a specific focus on compliance with U.S. regulatory standards. 8. Statutory register maintenance. Keeping the company's statutory register updated, including records of directors, shareholders, and other relevant data as mandated by U.S. law. 8. Ensuring strict adherence to requirements set by relevant U.S. regulatory authorities. 9. Meeting organization. Organizing and participating in both board and general meetings in accordance with U.S. corporate governance guidelines. The role of the company secretary is essential in upholding the legal and regulatory compliance of the company, ensuring transparency, accountability, and adherence to U.S. business standards. Number 5, and the final key components of the finance function is internal auditing. Effective risk management is crucial for protecting an organization from lasting damage. Internal auditors play a key role in this process by evaluating controls and processes to ensure they effectively mitigate risks. They ensure that controls are comprehensive and properly enforced. Internal auditors have a broader role as well. Their primary purpose is to provide objective assurance and advice to enhance the efficiency of an organization's operations. They conduct various types of audits. 1. Compliance audits. Ensuring adherence to policies and procedures, with a focus on uncovering fraud if present. 2. Value for money auditing. Assessing efficiency and effectiveness, often in the public sector. 3. Management audits. Evaluating the performance of managers and divisions to identify areas for improvement. 4. Social and environmental audits. Reviewing CSR and environmental performance, along with regulatory compliance. 5. Fraud investigations. Investigating suspected fraud to identify its extent and causes. 6. Project reviews, audits. Assessing project effectiveness and drawing lessons for future projects. Internal auditors contribute significantly to enhancing operational efficiency, compliance, and risk mitigation. While internal audits are valuable for assessing controls and processes within an organization, there are certain limitations that should be acknowledged. 1. Limited scope. Internal audits have a finite scope due to resource and time constraints. 1. This means that certain areas of the organization may not be thoroughly examined, leaving potential risks undiscovered. 1. For instance, if an audit focuses heavily on financial processes, operational or IT-related risks might not receive adequate attention. 2. Subjectivity and bias. Internal auditors, like any professionals, can be influenced by their own biases, experiences, and interpretations. 2. This subjectivity can lead to inconsistent assessments and recommendations. 2. For example, an auditor's prior positive experiences with a department might affect their objectivity when evaluating its controls. 3. Lack of independence. While internal auditors aim to maintain independence, their close ties to the organization can compromise this objectivity. 3. Internal auditors might hesitate to raise red flags about issues they fear could upset management or jeopardize their own positions. 3. This lack of true independence can undermine the credibility of the audit process. Understanding these limitations helps organizations take steps to mitigate them and ensures that the internal audit function is complemented with other risk management measures for a more holistic approach. Last point to be mentioned for the internal is audit committee. An audit committee consists of senior directors responsible for overseeing various aspects of the organization, including the work of internal auditors. Their key responsibilities include supervising internal audit activities to ensure they are aligned with the organization's major strategic risks. Additionally, the committee ensures that recommendations provided by the internal audit function are given due attention and are effectively implemented within the organization. This oversight role helps to maintain transparency, accountability, and the proper management of risks within the organization. As we conclude today's video, we want to extend our sincere gratitude for your viewership. Your time is truly valued. Thank you for watching. If you found the information in this video valuable, we invite you to consider subscribing to the channel. By doing so, you'll stay updated with our latest content. Don't forget to hit the notification bell icon as well, to ensure you receive timely alerts for all our new releases.